If you want a roller coaster of emotions as an investor, put your money in semiconductor stocks. The chip market loves volatility. 1 month, you're down 15%, and the next, you're up 20%. Such is the life you signed up for when you buy chip stocks. But despite this, I believe chip stocks are some of the best long-term buys out there. The secular growth expected in the industry is a key driver of this. Semiconductors are just so crucial to the existence of the modern economy. And today, we're discussing the earnings of Texas Instruments, the analog chip giant. Welcome to the Quality Investor. I view Texas Instruments, ticker TXN, as a sort of a staple within the chip industry. They make analog semiconductors, which are the backbone of many of the electronics we use daily. They certainly are not the sexy new AI chips, but we aren't looking for the hottest new toy. We are looking for steady compounders that create wealth for investors year in and year out. I've done videos on Texas Instruments business in the past. Please check them out. They are linked in the description below. So what is TXN then? TXN is a very profitable, both gross and operating, wealth creator for investors. However, TXN has been down badly the last year. They've had some gut-wrenching earnings reports seemingly showing nothing but decline, especially in what we care about most, revenue, margins, and free cash flow. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. But the chip market is also notoriously cyclical. So what we are looking at in earnings is how much of this decline is cyclical versus how much is fundamental to the business. If you listen to earnings calls of various analog chip makers, you no doubt heard many of the same sentiments. Customers adjusting inventories down, weakness across all end markets, factory underutilization, and much more. And TXN was not immune. So it was clear that the industry was in its trough part of the cycle. What indicates fundamental deterioration though? Businesses become bloated or less efficient, which shows up in the margins. They lose market share, whether by offering lower quality products or simply by being out-innovated by competitors, making acquisitions that don't add to the core operations of the business. These can alter a business's fortunes in a very negative way. Looking at TXN's earnings and comparing them with the last few quarters, I don't believe the fundamentals are deteriorating. In fact, I believe they are improving. TXN announced a major CapEx initiative a couple years ago. They were going to have 3 years of elevated CapEx spending, ending in 2025. At about $5 billion per year over the 3 years, it is much higher than their normal CapEx spend. Normally, TXN's CapEx as a percentage of net income is about 15 to 20%. The last 2 years, it is well over 80%. Wall Street seems to treat elevated spending as a negative, and sure, in the short term, it hurts free cash flow. But CapEx is an investment for future growth. It is certainly risky, but if management has shown itself to be smart in the past about that reinvestment, then it makes sense that it will continue to make smart investments. This is actually demonstrated by ROIC, or return on invested capital. TXN's ROIC has averaged 30% the last 10 years. So I trust that management knows what it's doing. But other investors worry about what that can do to its capital return, mainly the dividend. Again, I've demonstrated in other videos why that's not a concern. So let's dive into the earnings and see if TXN is actually turning it around. And more importantly, if it is worth buying more now that it is back over $200 per share. You can see since the earnings were released Tuesday after business close, Texas Instruments has been on a nice little run. They closed Friday at $206.93 a share. So since those earnings, they've been up about 6.5%. Even more interesting though, Texas Instruments has already been on a nice little run for all of 2024. You can see year to date, they're actually up 22%. Pretty impressive considering they've had a pretty bad 2024 all throughout their earnings reports. And this earnings was no different. We saw more year over year decline in revenue, and in income. Yet, we still saw the pop in share price after earnings. So what exactly is going on here? Why is the market actually liking what Texas Instruments is doing? At least for this earnings, there's two key things. First of all, they beat estimates. They reported $4.15 billion in revenue for the quarter, and the estimate was about $4.11 billion. Market likes it when you actually beat the estimates here. Earnings per share was $1.47, and that was compared to estimates, of course, of $1.36. Again, a nice beat on both top and bottom line numbers. And digging a little bit deeper, we can see that on the revenue analog, Texas Instruments' biggest segment, they had a $3.22 billion number for the quarter compared to a $3.14 billion estimate by analysts. And on the operating profit as well for the analog segment was at $1.32 billion versus $1.3 billion estimated. So on the biggest segment, they beat. But I think more importantly, what we're seeing sequentially, even though we're seeing a year-over-year decline, what we're seeing sequentially is growth, not only in revenue, the big numbers, but in the margins. I'm going to show you a bit more about that in a second. So when you look at the earnings, you can see that the revenue is actually down 8% year-over-year, but it did increase 9% sequentially. On the earnings call, there was a bit of negative sentiment around the industrial market, but all other end markets grew. And really, that understates what is actually happening. On the earnings call, they said the automotive market showed strong growth, especially in China, and personal electronics, enterprise systems, and communication equipment. All of those markets experienced significant sequential growth. So that's indicating here a recovery, finally, in the semiconductor industry, and especially in the analog industry. And of course, analog is the most important part of Texas Instruments business. Another thing to point out is all that CapEx they've had invested since 2023, $4.8 billion on a trailing 12 basis. We're starting to see that paying off just a little bit now in the cash flow from operations, which was $6.2 billion, and they're indicating the benefit of that 300 millimeter production. Now, I'm not going to go into technical aspects of that, but the point is they're investing for these more advanced chips. We're starting to see the seeds of these investments bearing fruit. Now, just to point out here, they had 1.7 this quarter alone of cash flow from operations and 1.3 billion in CapEx. So they still only had 416 million in free cash flow. Still down quite a bit from the norm of Texas Instruments, but I think they're getting hit right now on two different fronts. First, yes, we have elevated CapEx spending, and that's ultimately going to hurt free cash flow, but that's investment for future growth. But we're also in the trough part of the semiconductor cycle, and we're seeing that really play out in the inventories. TXN's customers were not buying new inventory, so TXN's inventories weren't moving. So they're getting a more bloated inventory on the balance sheet, and that's indicated in free cash flow by a decline from the cash from operations. If you look at the inventory decline from 2023, it's 1.2 billion subtracted from the net income, ultimately arriving at our cash flow from operations number, which essentially accounts for that decrease from 2022 to 2023. It's declining because the inventories themselves are building up. Think of it like this. You're spending cash to build inventory. So if inventories go up, that means cash is going down. And those inventories were up because the customers weren't buying. And the entire industry, especially in the analog part of the industry, was seeing that issue. So when we're seeing a recovery, we're going to be seeing those inventory levels come down again, which means those inventories are going to be sold and converted to cash. So now we have a negative $190 million hit to the cash flow for inventory. However, if you annualize that number, it's about half of what we saw in 2023. So that indicates again that those inventories are finally getting offloaded. We're seeing a little bit of recovery here. So let's look at the last few quarters here and see why I believe that Wall Street is actually pretty optimistic about Texas Instruments. First, the low point was in Q1 of this year. Revenues down 16% year over year, and the lowest operating margin on a quarterly basis they've had in a long time, 31.7%. And in fact, cash flow was negative in that quarter. But what we're seeing since then is a lot of positive indicators. First of all, the margin's increasing. 32.6% in Q2, now it's at 37.5% in Q3. We're seeing less year-over-year decline in revenue, so 15% in Q2, now just down 8%. Again, we want to see that growth. However, it's going in the right direction. And if they hit the top end of their estimates for Q4 on revenue, at worst, they're going to be flat year over year. At best, we could see them finally growing revenue on a year-over-year basis, going in the right direction. And on that point, they're pretty much tracking right along with what my year one estimates were for revenue. Operating profits off a little bit for my estimates, and the big reason for that is I think I overestimated the operating margin that they were going to have, so I did lower that on my analysis. Net income we're actually beating by about 6% against year one estimates, and earnings per share, same thing, about by 6%. Even though it's still down 15%. And cash flow is beating by 20% on what my estimates were. However, I do think that's actually going to track right along with what my year one estimate was, because right now we're including that Q4 number. And once that rolls out in the next quarter, we're not going to have that nice little pop there of that 776. It's going to only start with that negative 231. So I think we're going to be at about 1 to 1.1 billion in free cash flow, which would ultimately mean we're down by about 18% year over year. And I think that's going to be the low point for Texas Instruments going forward. So what does this all mean for their valuation? Are they actually worth buying right now? Like I mentioned before, they're back over $200 a share, yet they've had a pretty terrible year. And our estimates are based on this previous trailing 12 numbers, meaning we're starting from a lower point in free cash flow, estimating going forward. And ultimately, that's what we're doing. We're discounting that free cash flow back from 10 years to see if it's worth buying at today's price. So like I said, I lowered the operating estimate here by about 1% down to 35% for the year. And by year 10 on the base case, I'm expecting Texas Instruments to get back to a more normal level of operating margin at about 46%, 44% of the bear, but 50% on the bull case. And they've had a few quarters already where they've hit that 50% operating margin. This is assuming a lot of those investments are paying off for them that they're making right now. The interest expense margin right now is quite high, and that's due to the lower operating income that we're seeing. So it's the interest expense divided by the operating income to get this margin. That's 9.5% for year one. Hopefully that comes back down to about 7% by year 10, 5% on the bull case, 8% on the bear case. Income tax, about 13%, and we should expect to see that pretty much stable throughout the next 10 years. Free cash flow conversion right now is only at 26 cents. So only 26 cents of every dollar of net income is being converted to free cash flow. You can see the historical averages here in a 5 years at 77 cents and 99 cents for the 10 year. So in the base case, I'm basically expecting to get back up to that 5-year average and then about the 10-year average on the bull case. Once we're out of this CapEx spending cycle, we should see much more elevated free cash flow numbers. And in fact, generating that free cash flow is going to be an important part of the dividend. Right now, their free cash flow payout ratio for the dividend, it's over 100%, which is not sustainable for the long term. Their dividend is expected to be about $5.32 this year. And I'm expecting about 5% dividend growth over the next 10 years. But I'm being very conservative there. 7% on the bull case over the next 10 years and 4% on the bear case. And then perpetually about 5 to 5.5%. You can see historically they've had very strong dividend growth, but they've had to slow that growth down a little bit because of that CapEx spending. They're using resources right now to invest in the future. If it pays off, we're going to be rewarded with a much stronger dividend. Over the last 5 years, the analog segment has been the driver of growth for Texas Instruments. Its 5-year CAGR is at 3.8%. I'm estimating nearly 5% over the next 10 years for the analog segment, almost 9% if these investments pay off in the analog area and they hit their bull numbers. Embedded processing at about 8% for the bull and 1% on other, almost 4% on embedded processing for the base case, and 2% if everything goes wrong for Texas Instruments, as well as 3% for the analog. So ultimately, I'm expecting revenue growth to be about 4.5% over the next 10 years, assuming everything stays pretty stable and normal for them. But if they really get these investments up and running, we can expect to see over 8% revenue growth in the next 10 years. Ultimately, that brings us down to the free cash flow. Free cash flow is ultimately what we as investors want to see grow the most, and that means our share price will grow along with it. Assuming the bull case happens, we can see that free cash flow margin get up to about 40%. On a base case, about 28% margin, and on a bear case, about a 22.6% margin. We have a 9.3% free cash flow margin right now, again, depressed a little bit due to that double whammy of CapEx and the semiconductor trough. So ultimately, where does that bring us for evaluation? Like I said earlier, their share price closed at $206.93 on Friday. It's earnings per share of $5.38. Right now, their PE ratio is at a pretty high 38.5. You can see it's higher than both their 5 and 10-year averages, 23.3 and 22.4 respectively. The forward PE is at 45.1. So we're still projecting earnings decline in year one. And that's much higher than the 5 and 10-year averages at 22.9 and 20.6. So on a DCF basis, on the bear case, they're worth $69.10. That's assuming, like I said, 2.6% revenue growth and a 44% operating margin. On the base case, $100.14. And on the bull case, at $199.86. And remember, that's 8% growth on the bull with a 50% operating margin. Using the dividend discount model, we're seeing a bear case of $139.97, base at $165.92, and the bull case at $209.62, or right about where their share price is right now. The exit multiple is really what's elevating Texas Instruments' valuation, in my opinion. $347.55 for the exit multiple price. And that's based on comps of Broadcom, Qualcomm, Intel, Monolithic Power Systems, Microchip Technology, another stock I own by the way, and ON Semiconductor. That's a median PE of those businesses of 62.9. So you can see there's optimism for this industry based on that PE, but we also know that Texas Instruments is trading at much more elevated levels right now than what they're historically accustomed to. It would take a lot of growth to justify these high PE ratios for TXN. So that would be a 24.4% decline on the bear case, assuming a valuation average of $156.43, 13.7% decline on the base case, and a modest gain of 15.6% on the bull case. Our bull price is only $239.22. So right now, without any margin of safety, we're looking at a buy price of $188.13, or what they were trading at only a few weeks ago. That's still a forward PE of 41. Using a 20% margin of safety, that's $150.51 and a forward PE of 32.8, which in my view is still a little bit high. There's not a lot of growth expected for Texas Instruments, and I'd like to see them come down maybe to the below 140 into the 130s, 120 range with a 30% margin of safety. This has to be a very reasonably priced stock for me to want to buy more of it. I do own quite a bit now. I've had a nice gain, but I think it's way too expensive right now to consider buying more. I do think there's a lot of positives happening right now for Texas Instruments. They are increasing their market share, which is the sign of a healthy business. Compared to their competitors, they had a market share of 9.75% in the trailing 12 months at Q2, compared to 9% in trailing 12 at Q1. So a little bit of growth, but still, they're increasing the market share. The source I'm using for that's linked below. Margins are back on the rise. Revenue might actually have a chance of growing year over year next quarter, but I just don't think there's enough growth to justify the $200+ share price at the moment. So right now, their ROIC is at 17%. If these investments pay off, we should definitely expect to see them get back up to the 30% level on the 10-year average. Again, Texas Instruments has excellent management, so I trust that they know what they're doing. We want to see the margins get back up, the operating margin especially get back up to at least 45%. If they can hit the bull case numbers, they're pretty much priced right where they should be right now. They will have to do an exceptional job of exceeding expectations over the next few years to justify a much higher valuation. But all in all, I think Texas Instruments is a great business and it's very good for a dividend investor, but we just want to see a little bit more growth. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.